Our company has delivered outstanding results in 2024, with a strong focus on growth and profitability. We're committed to continuing this momentum and exploring new opportunities to drive further growth and expansion. Key highlights: 1 billion euros in adjusted revenue, a 25% increase from last year's 6 billion euros in order intake, a 71% increase from last year 161 million euros in adjusted EBITDA, a 51% increase from the previous year 53 million euros in adjusted net income, a 54% increase from the previous year 391 million euros in free cash flow. A record-breaking amount. Growth drivers: strong demand for our products and services, effective pricing strategy, improved operational efficiency, strategic investments in new markets and technologies. Challenges and opportunities: balancing growth with profitability, managing supply chain complexities, adapting to changing market conditions, exploring new opportunities for expansion and growth. Conclusion: our company has delivered outstanding results in 2024, with a strong focus on growth and profitability. The road to revenue growth: the journey to achieving significant revenue growth is a complex and multifaceted one. For companies like our parent company, the goal is to accelerate revenue growth at the group level, while also driving growth in specific areas such as value-added services, VAS. In this article, we will delve into the strategies and initiatives that are being implemented to achieve these ambitious targets. Key objectives: accelerate revenue growth at the group level, around 40%. Drive growth in value-added services, VAS, revenue, around 80%. Increase adjusted EBITDA margin by 100 to 200 bps. The importance of value-added services. Value-added services, VAS, are a critical component of our parent company's growth strategy. These services provide a unique value proposition to customers, setting us apart from competitors and driving revenue growth. In order to achieve our VAS revenue growth target of around 80%, we need to focus on several key areas: enhancing customer experience. Providing exceptional customer service and support is essential for driving customer loyalty and retention. Investing in new technologies. Staying ahead of the curve in terms of technology is crucial for delivering innovative VAS solutions that meet the evolving needs of our customers. A year of exceptional growth. The year 2024 was marked by a remarkable 25% annual growth, exceeding expectations and solidifying VusionGroup's position as a leading player in the industry. This achievement is a testament to the company's strategic planning, innovative approach, and dedication to delivering exceptional results. Key highlights of 2024: revenue growth of 47% in the fourth quarter, exceeding 350 million euro. Strong growth in North America, with a significant increase in market share. Europe achieved its best quarter of the year, driven by increased demand for VusionGroup's products. Annual growth of 25%. In line with the company's average annual growth rate. Driving forces behind the growth. Several factors contributed to VusionGroup's exceptional growth in 2024. These include innovative product development. VusionGroup invested heavily in research and development, resulting in the launch of new and innovative products that met the evolving needs of customers. Strategic partnerships. The company formed strategic partnerships with key players in the industry, expanding its reach and increasing its market share. Effective marketing and sales strategies. VusionGroup implemented targeted marketing and sales campaigns, resulting in increased brand awareness and customer engagement. 2024 was also the year of the accelerated launch of EdgeSense, a new digital shelf system. The rise of North America as a key market. North America has emerged as the largest geographic market in 2024, marking a significant milestone in the industry's growth trajectory. This achievement is a testament to the region's strong dynamics, which have driven the market's expansion and cemented its position as a key player in the global market. Key factors contributing to North America's success. Several factors have contributed to North America's success in 2024. These include growing demand for digital solutions. The increasing adoption of digital technologies has led to a growing demand for digital solutions, including digital shelf systems like EdgeSense. Advancements in technology. The region's strong technological infrastructure has enabled the development and deployment of innovative solutions, such as EdgeSense. Strategic partnerships, collaborations between industry leaders and technology providers have facilitated the growth of the North American market. ##The accelerated launch of EdgeSense ***. The accelerated launch of EdgeSense. The accelerated launch of EdgeSense in 2024 was a significant event in the industry. Revenue growth poised for significant expansion. The future of revenue growth. As we look ahead to 2025, our company is poised for significant revenue growth. With a projected increase of around 40% to reach €1.4 billion, we are confident that our business strategy is on the right track. This growth rate is not only impressive but also twice that of our group revenue, indicating a strong and sustainable expansion. Key drivers of revenue growth. Several key factors are driving our revenue growth, including increased demand for our products and services, expansion into new markets and geographies, improved operational efficiency and cost management, strategic partnerships and collaborations, enhanced customer experience and satisfaction. These drivers are expected to continue to propel our revenue growth in the coming years, as we focus on delivering high-quality products and services that meet the evolving needs of our customers. The impact on EBITDA margin. In addition to revenue growth, we are also expecting an improvement in our EBITDA margin of 100 to 200 basis points. The group's sales performance. The group's sales performance has been a key focus area for the company in recent years. In 2024, the group achieved a significant milestone, reaching €1,010.5 million in adjusted sales, representing a 25% increase compared to the previous year. This growth can be attributed to various factors, including the expansion of its product portfolio, improved operational efficiency, and a strong focus on digital transformation. Key drivers of growth. Several key drivers contributed to the group's sales growth in 2024. The rise of the Americas and Asia-Pacific region. The Americas and Asia-Pacific region has experienced unprecedented growth, with adjusted revenue reaching €518.2 million in 2024. This represents a staggering plus 218% increase compared to the previous year, 2023. The region has surpassed the group's previous records, marking a significant milestone in its history. Key drivers of growth. Several factors have contributed to the region's remarkable growth. Some of the key drivers include increasing demand for digital solutions. The region has seen a significant increase in demand for digital solutions, driven by the growing need for online services and digital transformation. Growing middle class. The growing middle class in the region has led to an increase in disposable income, driving demand for consumer goods and services. This represents a significant increase from the previous year's adjusted revenue of €83 million. The growth was driven by the expansion of the company's operations in the region, as well as the successful implementation of new business strategies. The rise of the region. The region has experienced a remarkable transformation in recent years, driven by a combination of factors. These include a growing demand for the company's products and services, the expansion of the company's operations into new markets, the successful implementation of new business strategies, the growth of the local economy. Key drivers of growth. The growth in the region was driven by several key factors. These include the expansion of the company's operations into new markets, the successful implementation of new business strategies, the growth of the local economy, the increasing demand for the company's products and services. Challenges and opportunities. Despite the significant growth in the region, the company faces several challenges and opportunities. This represents a significant decline in revenue from these activities, which accounted for 44% of the company's total revenue in 2023. Revenue breakdown. VAS revenue €7 million in 2024, down -3% from 2023. 44% of total revenue in 2023. Decline in revenue from VAS activities. Impact on the company. Decline in revenue. The decline in revenue from VAS activities has had a significant impact on the company's overall performance. VusionGroup will continue to invest heavily in its cloud infrastructure and continue to expand its ecosystem of partners and integrations with leading providers in the retail and e-commerce industries. To do this, we will be investing heavily in the development of our cloud platform, including the integration of new technologies and the acquisition of strategic partners. This will enable us to better support our customers and improve our competitive positioning in the market. As a result, we expect to see significant growth in our cloud services, with the potential for up to 10% annual growth rate. I will generate a detailed and comprehensive text based on the provided summary. 2022 €173.9 million. The VCM is a key metric for assessing the profitability of a company's operations. It represents the difference between the variable costs incurred by the company and the variable revenue generated by its products or services. The importance of adjusted variable cost margin, VCM. Understanding the concept of VCM, the adjusted variable cost margin, VCM, is a financial metric that measures the profitability of a company's operations by comparing its variable costs to its variable revenue. It is an essential indicator for businesses to evaluate their operational efficiency and make informed decisions about pricing, production, and resource allocation. Key characteristics of VCM variable costs. These are costs that vary directly with the level of production or sales. Examples include raw materials, labor, and energy costs. Variable revenue. This refers to the revenue generated by a company's products or services, which also varies directly with the level of production or sales. Adjusted. The adjusted VCM takes into account non-variable costs, such as fixed costs, to provide a more accurate picture of a company's operational profitability. Calculating the adjusted variable cost margin, VCM, *** calculating the adjusted variable cost margin, VCM. Formula. The formula for calculating the adjusted VCM is, VCM equals variable costs, variable revenue, / variable revenue. Example: suppose a company has variable costs of €100,000 and variable revenue of €120,000. The adjusted VCM would be VCM equals 100,000 to €120,000, / €120,000 equals minus 0.17 or minus 17% interpretation. A negative VCM indicates that the company is operating at a loss, while a positive VCM indicates that the company is generating profits. The impact of the group's strategic partnerships with leading companies in the industry, which enabled the group to leverage their expertise and resources to improve its VCM rate. The impact of the group's focus on operational efficiency and cost optimization, which allowed the group to reduce its costs and improve its VCM rate. Improving the VCM rate, a key to unlocking growth. The vehicle cost management, VCM, rate is a critical metric for any automotive manufacturer. It represents the cost of producing a vehicle, including all the expenses associated with its development, production, and delivery. Operating income, a key performance indicator. Operating income, also known as EBITDA, is a widely used metric to evaluate a company's financial performance. It represents the profit earned by a business from its core operations, excluding non-recurring and non-cash items. What is EBITDA? EBITDA is calculated by adding up the following components: revenue, cost of goods sold, COGS, gross profit, operating expenses, depreciation and amortization, other non-recurring and non-cash items. For example, let's consider a company that sells widgets. Its revenue might be €100 million, COGS might be €60 million, and operating expenses might be €20 million. The gross profit would be €40 million. If the company has €10 million in depreciation and amortization expenses, and €5 million in other non-recurring and non-cash items, its EBITDA would be €100 million, revenue, €60 million, COGS, equals €40 million, gross profit, €40 million, gross profit, €20 million, operating expenses, equals €20 million, €20 million plus €10 million, depreciation and amortization, plus €5 million, other non-recurring and non-cash items, equals €35 million. In this example, the company's EBITDA is €35 million. Why is EBITDA important? EBITDA is an important metric because it provides a clear picture of a company's financial performance, excluding non-recurring and non-cash items. This is a one-time expense that will not be repeated in future years. The impact of non-cash and non-recurring items on a company's financial statements. Non-cash and non-recurring items are expenses that do not require cash outflows and are typically recorded as expenses in a company's financial statements. The company's foreign exchange exposure is primarily due to its significant presence in the European market, which is subject to fluctuations in the euro to US dollar exchange rate. The impact of foreign exchange exposure on a company's financials. Understanding the risks. Foreign exchange exposure is a significant risk for companies operating in multiple currencies. The euro to US dollar exchange rate, in particular, has a profound impact on a company's financials due to its high volatility. This volatility can result in substantial losses or gains, depending on the direction of the exchange rate movement. Key factors contributing to foreign exchange exposure. Geographic presence. Companies with a significant presence in the European market are more exposed to the euro to US dollar exchange rate fluctuations. Financial debt. The interest expense on financial debt can be affected by the exchange rate movement, leading to increased costs. Revenue and expenses. Foreign exchange exposure can impact a company's revenue and expenses, resulting in changes to its financial performance. ###The consequences of foreign exchange exposure. ***The consequences of foreign exchange exposure. The consequences of foreign exchange exposure can be far-reaching, affecting a company's financials, operations, and overall performance. Some of the key consequences include foreign exchange losses. Companies may incur significant losses due to unfavorable exchange rate movements. Increased costs. Foreign exchange exposure can lead to increased costs, including interest expense on financial debt. Walmart's complex financial arrangement relies on a parent-subsidiary structure to efficiently manage global operations. The parent company then lends the dollars to the American subsidiary, which uses them to pay for the production lines. The Walmart contract. A complex financial arrangement. The parent-subsidiary structure. The Walmart contract is a classic example of a parent-subsidiary structure, where the parent company lends money to its subsidiary to finance production lines. This structure is commonly used in multinational corporations to manage their global operations efficiently. Key players involved: Walmart Incorporated, the parent company, which owns the U.S. subsidiary. Walmart U.S., the U.S. subsidiary, which receives the financing and invests in production lines. Group, the parent company, which borrows dollars from its American subsidiary to finance the production lines. ###How the contract works. ***How the contract works. The contract involves the following steps. Financing. The U.S. subsidiary receives the financing for the production lines from the parent company. Investment. The U.S. subsidiary invests the dollars in the production lines. Lending. The parent company lends the dollars to the U.S. subsidiary. The financial performance of VusionGroup in 2024. Overview of the financial results. VusionGroup's financial performance in 2024 was marked by a significant decline in net income, with the company reporting a net loss of -28.9 million euros. This decline can be attributed to various factors, including increased competition in the market and the need to invest in new technologies and infrastructure to remain competitive. Capital expenditure and cash investments. The company's capital expenditure for 2024 was substantial, totaling 158.0 million euros. This includes 40.7 million euros in cash capital expenditures, which represents a significant portion of the total expenditure. The remaining 117.3 million euros was financed through pre-financing. The company's cash investments also played a crucial role in its financial performance, accounting for 4% of adjusted sales in 2024. Analysis of the financial results. The decline in net income can be attributed to several factors, including increased competition in the market, which has led to a decrease in sales and revenue. The need to invest in new technologies and infrastructure to remain competitive, which has resulted in increased capital expenditure. The impact of currency fluctuations on the company's financial performance. ###Conclusion. ***Conclusion. In conclusion, VusionGroup's financial performance in 2024 was marked by a significant decline in net income, due to various factors including increased competition, the need for investment in new technologies and infrastructure, and the impact of currency fluctuations. The EdgeSense range, a key focus area for VusionGroup's investment in production lines, is a strategic move to support the growth of its EdgeSense range of products. A new digital shelf system, EdgeSense, was launched in 2024, which enables the company to provide a more personalized shopping experience for customers. The system uses AI-powered chatbots to offer personalized product recommendations and offers a seamless shopping experience. With the new system, customers can browse products, compare prices, and make purchases with ease. The system also provides real-time inventory updates, ensuring that customers can find the products they want in stock. The rise of EdgeSense, revolutionizing the retail experience. EdgeSense, the new digital shelf system, has been making waves in the retail industry since its launch in 2024. This innovative system is designed to provide a more personalized shopping experience for customers, and its impact is being felt across various retail sectors. Key features of EdgeSense: AI-powered chatbots. EdgeSense uses AI-powered chatbots to offer personalized product recommendations to customers. The company has been working on this project for several years, and the prototype has been tested with a group of retail clients. The birth of VusionLive is an AI-powered assistant designed to help stores and retailers optimize their operations, improve customer experience, and increase sales. The group's financial performance in 2024. The group's financial performance in 2024 was marked by significant improvements in its net cash position, driven by various factors such as cost optimization, revenue growth, and strategic investments. Key highlights of the group's financial performance: revenue growth. The group's revenue increased by 10% compared to the previous year, driven by the expansion of its product offerings and the growth of its customer base. Cost optimization. The group implemented various cost-saving measures, including the reduction of operational expenses and the optimization of its supply chain. Equity performance plan unwinding. The group has decided to unwind its equity performance plan dedicated to the teams in the United States. This decision was made in 2024, and it is a strategic move to optimize the company's capital structure. Why unwind the plan? The plan was created to recognize and reward the team's hard work and achievements. However, given the growth prospects of the company, it seemed logical to sell the plan in cash and treasury shares rather than generating revenue. This decision was made to maintain a more efficient capital structure. Impact on treasury shares. The group held treasury shares acquired at an average price of €113. The reference price at the time of unwinding was €146. This means that the company will receive a lower value for the treasury shares compared to their original purchase price. The unwinding of the equity performance plan will result in a loss of €33 per share, as the reference price is €146 and the average purchase price was €113. The company will receive treasury shares in exchange for the cash and shares, which will be used to offset the loss. The unwinding of the plan will also have a positive impact on the company's capital structure, as it will reduce the number of outstanding shares. Conclusion: the group's decision to unwind its equity performance plan is a strategic move to optimize the company's capital structure. By selling the plan in cash and treasury shares, the company can maintain a more efficient capital structure and reduce the number of outstanding shares. While there may be a loss of €33 per share, the company will receive treasury shares in exchange for the cash and shares, which will be used to offset the loss. VusionGroup poised for sustained growth and profitability in 2025. The future of VusionGroup, a look ahead to 2025. As we approach the midpoint of the decade, VusionGroup is poised to continue its trajectory of growth and profitability. With a strong foundation established, the company is now focused on sustaining its momentum and exploring new opportunities for expansion. Financial performance: VusionGroup's financial performance has been a key driver of its success. The company has consistently generated positive free cash flow, which has enabled it to invest in its business and return value to shareholders. In 2025, VusionGroup expects to continue this trend, with a proposed dividend to be presented at the annual general meeting on June 17, 2025. Key highlights of VusionGroup's financial performance include plus consistent generation of positive free cash flow plus strong investment in the business plus return of value to shareholders through dividends. Strategic focus. VusionGroup's strategic focus is centered around driving growth and profitability. The company is committed to investing in its business, expanding its product offerings, and exploring new markets. This strategic approach is designed to position VusionGroup for long-term success and sustainability. Key aspects of VusionGroup's strategic focus include plus investment in business growth and expansion plus development of new products and services plus exploration of new markets and opportunities. Outlook and projections. Looking ahead to 2025, VusionGroup is confident in its ability to continue generating positive free cash flow. The company's strong financial performance and strategic focus position it well for long-term success. VusionGroup poised for substantial revenue growth in 2025. The rise of VusionGroup, a promising start to 2025 as we enter the new year. VusionGroup is poised to make a significant impact in the market. With a strong level of visibility and confidence, the company is expected to experience a substantial growth in its revenue. In this article, we will delve into the details of VusionGroup's growth prospects and explore what this means for the company and its stakeholders. Key growth indicators. Revenue growth. VusionGroup's total VAS revenue is expected to grow by around 80% in the current first quarter. First quarter growth. The company is expected to experience a growth of around 25% to 30% in the first quarter of market confidence. VusionGroup has a strong level of visibility and confidence at the beginning of 2025, indicating a positive outlook for the company. What drives VusionGroup's growth? VusionGroup's growth can be attributed to several factors, including what drives VusionGroup's growth. VusionGroup's growth can be attributed to several factors, including strong product offerings. The company's product offerings are highly competitive, providing customers with a range of options to choose from. Effective marketing strategies. VusionGroup's marketing strategies are well planned and executed, resulting in increased brand awareness and customer engagement. Strategic partnerships. The company has formed strategic partnerships with other businesses, expanding its reach and offerings. Implications for stakeholders. Implications for stakeholders. VusionGroup's growth prospects have significant implications for its stakeholders, including investors. The company's growth is expected to result in increased investor confidence, potentially leading to increased investment and funding. VusionGroup unveils ambitious strategic plan to drive growth and profitability. The data is not audited and is not intended to be used for financial reporting purposes. The VusionGroup strategic plan, a roadmap to success. The VusionGroup, a leading provider of innovative solutions, has outlined its ambitious strategic plan, dubbed Vusion 27. This comprehensive plan aims to drive growth, improve profitability, and enhance the company's competitive edge. In this article, we will delve into the key objectives and expectations of the VusionGroup's strategic plan, highlighting the potential for success and the factors that will contribute to its achievement. Key objectives of the Vusion 27 strategic plan. The Vusion 27 strategic plan is built around several key objectives, which are designed to drive growth, improve profitability, and enhance the company's competitive position. These objectives include improving profitability through increased efficiency and cost optimization, enhancing the company's product offerings and services to meet evolving customer needs, expanding the company's global presence through strategic partnerships and investments, developing a strong and agile organizational structure to support growth and innovation. Expected outcomes and performance metrics. The VusionGroup expects significant improvements in its financial performance, with adjusted EBITDA margin growing by 100 to 200 bps in 2025. This increase in profitability is expected to be accompanied by positive free cash flow generation, which will enable the company to invest in its growth initiatives and return value to its shareholders. Positive outlook and confidence. Given the positive outlook and the expected outcomes, VusionGroup remains confident in its ability to achieve the objectives of its Vusion 27 strategic plan. The contract asset is calculated as follows. The contract value is 2 billion euros. The contract term is 5 years. The projected revenue is 240 million euros per year. Using the provided summary, generate a detailed and engaging article. Introduction. The world of finance is constantly evolving, and companies must adapt to changing regulations and market conditions. One such example is the impact of the new Walmart contract on the financial disclosures of several IFRS, International Financial Reporting Standards, restatements. In this article, we will delve into the details of this impact and explore how it affects the financial statements of companies involved. The new Walmart contract. On June 2, 2023, the fair value of the warrants was established at 163 million euros. This contract asset is a fixed amount that is amortized in proportion to the projected revenue generated by Walmart. To understand the impact of this contract on the financial disclosures, we need to break down the contract value, term, and projected revenue. Contract value and term. The contract value is 1.2 billion euros, which is a significant amount that will be amortized over the contract term of 5 years. The company's financial debt is subject to a revaluation at each closing date depending on the number of exercisable warrants and the stock market price of the VusionGroup share. The impact of future price reductions on VusionGroup. A new era for electronic shelf labels. The recent agreement between VusionGroup and Walmart has sent shockwaves throughout the retail industry. The deal, which involves the installation of electronic shelf labels, ESLs, in Walmart stores, is expected to have a significant impact on the company's financials. One of the key aspects of the agreement is the promise of future price reductions indexed to the volumes agreed upon with Walmart. The benefits of ESLs have been touted as a game-changer for retailers, offering a range of benefits that can help to improve operational efficiency and reduce costs. Some of the key advantages of ESLs include improved accuracy. ESLs can provide real-time pricing and inventory information, reducing the risk of human error and improving the overall accuracy of inventory management. Introduction. The International Accounting Standards Board, IASB, introduced IAS 21, Foreign Currency Transactions and Adjustments, to address the complexities of foreign currency transactions and their impact on financial statements. One of the key areas where IAS 21 has a significant impact is on the reciprocal debt and receivables between a parent company and its foreign subsidiary. EBITDA and net debt, a key to unlocking financial performance and risk assessment. The group considers EBITDA as a key performance indicator, and the level of net debt or net financial debt is considered a risk factor. The importance of EBITDA and net debt in financial analysis. Understanding EBITDA. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. It is a widely used performance indicator in financial analysis, particularly in the corporate world. EBITDA is calculated by adding back non-operating items such as interest, taxes, depreciation, and amortization to the net income of a company. This calculation provides a clearer picture of a company's profitability, as it excludes the effects of capital structure and financing decisions. Key benefits of EBITDA. Provides a more accurate picture of a company's profitability, helps to compare companies with different capital structures, allows for a more comprehensive analysis of a company's financial performance, enables investors to make more informed investment decisions. The significance of net debt. Net debt, also known as net financial debt, refers to the difference between a company's total liabilities and its cash and cash equivalents. In the context of the group, the level of net debt is considered a risk factor. Assessing a company's liquidity and financial health through working capital calculations. Calculating working capital. Calculating working capital is a crucial step in assessing a company's liquidity and financial health. It is a key indicator of a company's ability to meet its short-term obligations and is often used to evaluate a company's financial performance. Understanding the components of working capital. Working capital is calculated by considering the following components from the consolidated balance sheet: receivables, gross value, before depreciation, trade payables, current taxes, other current receivable, other debt, and accrual accounts. These components are essential in determining the company's working capital, as they represent the amount of money available to meet its short-term obligations. Calculating the change in working capital. The change in working capital is calculated by subtracting the opening balance of working capital from the closing balance of working capital. VusionGroup's mission is to empower businesses to achieve their full potential through digitalization, while promoting a culture of sustainability and social responsibility. The vision of VusionGroup. At the heart of VusionGroup's mission lies a clear vision for the future of commerce. VusionGroup's innovative solutions help retailers to optimize their operations, enhance customer experience, and drive business growth. Introduction. In today's fast-paced retail landscape, the traditional brick-and-mortar store is facing stiff competition from e-commerce giants. To stay relevant, retailers must adapt and evolve their business models to meet the changing needs of their customers. This is where VusionGroup comes in, a cutting-edge technology company that empowers retailers to transform their physical stores into efficient, intelligent, connected, and data-driven assets. The power of data-driven retail. At its core, VusionGroup's solution is built around the concept of data-driven retail. By leveraging advanced technologies such as artificial intelligence, machine learning, and the Internet of Things, IoT, retailers can gain a deeper understanding of their customers' behavior, preferences, and shopping habits. VusionGroup has also been recognized for its commitment to diversity, equity, and inclusion by being named a Best Place to Work by the Human Rights Campaign. VusionGroup, a leader in sustainability and inclusion. A commitment to sustainability. VusionGroup, a leading provider of digital solutions, has demonstrated its dedication to sustainability by supporting the United Nations Global Compact initiative. Introduction. The retail industry has undergone significant changes in recent years, driven by technological advancements, shifting consumer behaviors, and increased competition. One of the most influential players in this industry is Walmart, the world's largest retailer. In this article, we will delve into Walmart's financial performance, focusing on its revenue growth, profitability, and cash flow management. Revenue growth. Walmart's revenue growth has been a topic of interest for investors and analysts alike. The company's revenue has been steadily increasing over the years, driven by its strong brand, efficient supply chain, and strategic expansion into new markets. Walmart's revenue has grown from $285 billion in 2010 to $524 billion in 2020, representing a compound annual growth rate, CAGR, of 4.5%. The company's revenue growth has been driven by its e-commerce business, which has grown from 2% of total sales in 2010 to 10% in 2020.